And welcome to the Tech Roundup podcast from Northridge Partners. We're the tech investment bank that advises on capital raisings and M&A across four technology verticals: travel tech, software and AI, aerospace and defence, and fintech. Northridge Partners is in a global partnership with one of the Northern Hemisphere's leading tech investment banks, GP Bullhound. That gives us a collective 200 professionals in 17 offices around the world. And our team has been involved in an awful lot of travel and travel tech deals over our careers. Nearly $20 billion of them at last count. I'm your host, Jimmy Gemini. Today's question is a simple one. What does it take to kill travel? Over 76 years of evidence, the answer is that you can't kill travel per se, but the companies that sell it to you can certainly be disrupted. Our latest study, Travel is a Cockroach, examines 19 major shocks across those 76 years, from Korea and Suez, through oil embargoes, SARS, the GFC, COVID, the 2026 Hormuz crisis, and now another technology disruption, artificial intelligence. There's a pattern running through all these crises. There are typically four forces that disrupt travel constantly. They're war, pandemics, economic shocks, and new technologies. And fittingly, your presenters today call ourselves the Four Horsemen of the travel apocalypse. Each of us will discuss the way in which the disruptions that we are named after affect the travel sector. And in full disclosure, we're not actually human. We're AI-generated presenters. Penny, why don't you start by introducing yourself?
Thanks, Jimmy. I'm Penny Pandemic. I'll be speaking about health crises, closed borders, empty aircraft, and finding out exactly how long a travel company survives with no travelers. Pandemics deliver the deepest demand shock of the lot, yet people come back faster than the forecasters expect. Over to you, Harry.
I'm Harry Hormuz. I'll cover war, geopolitical disorder, and the occasional closure of a strategically important waterway. Sound familiar, anyone? Wars close airspace, reroute planes, and push fuel bills higher. Travel usually shrugs off the headlines, but it always notices the oil bill. Over to you, Margot.
Thanks, Harry. I'm Margot Meltdown. I'm a subject matter expert in economic turmoil, recessions, market crashes, capital scarcity, nervous consumers, and the precise moment a growth plan becomes a covenant discussion. Meltdowns rarely stop people travelling, but they're brilliant at exposing a weak balance sheet. Back to you, Jimmy.
And last but by no means least, my name, Jimmy Gemini, was chosen for a reason. My specialty is how new technology disrupts the travel sector, often seemingly coming from nowhere.
That's right, Jimmy. And here's the pattern. People simply keep travelling. More of them, decade after decade. But how travel is delivered keeps changing. And every time it does, enormous value moves from the old guard to the new. These shifts don't run to a neat timetable. They come every decade or two. And they're usually triggered, or at least accelerated, by one of our four shocks: war, pandemics, economic crises, and new technology. Jimmy, talk us through the growth and the disruption.
The growth numbers are staggering. International arrivals grew from about 25 million in 1950 to a record 1.5 billion passengers in 2025. Indeed, travel has never failed to grow across a full decade. And with the world's population aging, there's a swarm of grey nomads queuing up to travel. How many industries can comfortably predict over 5% annual growth for decades to come? And while all that growth occurs, their delivery mechanisms typically attract and lose capital as cycles unfold. For instance, in the 50s, we witnessed major technological disruption as ships gave way to aircraft. By 1957, more people crossed the Atlantic by air than by sea. And as a result, scheduled Cunard transatlantic voyages had all but disappeared by the late 60s. Then, in the 90s, assets gave way to brands. Marriott's 1993 split created the asset-light model, where the property owner kept the building and the pain, and the brand owner kept a fee and slept rather better. Then, in the late 90s, travel moved online. The OTAs like Priceline, Expedia, Travelocity, Last Minute, and Webjet all arrived around the turn of the century. The dot-com crash may have trashed their share prices, but it didn't trash their business model. Priceline fell 99% from a split-adjusted $974 to under $7, and then rose from the ashes as Booking Holdings, which became one of the great wealth creators of all time, both a culling and a coronation. And the fourth migration currently underway is from websites and apps to AI agents. Artificial intelligence sits above the whole booking chain: intent, supplier, price, payment, before a travel company even sees the customer. Okay, let's dissect these four disruptions. Penny, why don't you start with pandemics since they're so top of mind?
In a nutshell, Jimmy, people are almost impossible to keep at home. COVID was the deepest interruption in modern history, and demand still came roaring back. With COVID-19 still firmly etched in our minds, none of us want to be told that we cannot travel. The catch is that the industry survives and thrives through pandemics, but not all companies within it are as fortunate. COVID rewarded companies that had liquidity, scale, and access to capital. Strong online platforms bounced fast, but the highly leveraged ones and the inefficient operators quietly left the building. Okay, that's pandemics. Harry, let's move to the impact that wars have on travel.
War is an emotive subject, and rightly so. But here's what I've learned over many cycles. Fuel kills, but fear only bruises. For instance, the Six-Day War cost hotel shares just 4% of their value and 2 trading days of losses, and both October 7th and the Red Sea were repaired inside 2 months. But the 1973 oil embargo was much, much bigger. It cut airline shares by 42% and hotels by 68%, with hotels taking 858 trading days to recover. Yes, let that sink in. 858 days. The 2026 Hormuz crisis ran true to type. Jet fuel nearly doubled in 10 weeks, physical travel shares fell 10 to 20%, then recovered quickly as fuel eased. It does need to be said, however, that Asia-Pacific copped it hardest. Qantas down 34% and Air New Zealand down around 30%. And clearly, as the events of the past few days show, this is going to go on for a while. So, if I was to summarize the effects of war on travel, I'd say travel is like water. It always finds a way through. People still travel in times of war. They just go somewhere else. Margot, over to your department. Economics, markets, and money.
History shows that money moves in sequence, and you can almost set your watch by it. When there's economic disruption, public equities fall first, with the IPO window slamming shut almost overnight. Private valuations then fall, typically with a lag of a year or two, because founders and VCs typically resist cutting valuations. Then M&A fills the gap last of all, once sellers finally accept lower prices. This cycle occurred when the IPO window opened during ZERP and SiteMinder and Airbnb got their IPOs away. Then it bolted shut in 2022 as interest rate hikes commenced. The VC funding cycle tracked this clock exactly, with travel tech VC funding peaking at $16.3 billion in 2021, halving to $5.3 billion by 2023, and by late 2025, it was running at just $3.5 billion across 161 rounds, down from around 1,000 rounds a decade earlier. But true to form, then came the M&A cycle, with record numbers of deals in 2023 and 24, and more than 40 travel tech deals in a single quarter in 25. So, where are we today? Travel tech funding is currently shaped like a barbell, with disciplined seed checks being written at one end and larger AI-badged rounds getting away at the other. But the middle is in a tough squeeze. It's full of sound but stranded companies that are stuck on 2021 valuations and don't have the capital they need to scale. Broadly speaking, these companies have 3 survival options. 1, work out how to accelerate growth without raising expensive capital. 2, bite the bullet and raise money in a down round to get growing again. Or 3, merge with someone else. The alternative looks distinctly like a zombie future. And a word to anyone stuck in the middle, forget your 2021 valuation, because zero interest rates aren't coming back anytime soon. So that's how markets affect travel tech. Now let's turn to AI. Jimmy?
It's important to be clear on a few fundamentals and to be on high alert, but it's also important to not get carried away with the AI hype that's so prevalent right now. Chatbots don't magically recreate contracting, inventory, payments, servicing, loyalty, or supplier relationships. The conversation is the easy part, the machinery underneath is the hard part, and the incumbents own it. AI won't wipe out the sector, it'll sort it, and it'll make some players stronger. So in my view, we are witnessing a Darwinian reckoning, but not an extinction event. Scaled demand, proprietary supply, and trusted payments have real defenses. Commodity connectors don't.
So, we've now given you a 76-year history of travel growth and disruption. We know that travel is like a cockroach. It's very hard to kill. We know that most wars have a very limited effect on travel demand. We know that people will travel as soon as they can as pandemics come and go. We know that economic crises favor those with strong balance sheets. And we know that long-term oil crises can cause real mayhem. We also know that AI is likely a Darwinian moment. So, Margot, a question for you, given all the above, why have travel tech share prices have been so brutally smashed in 2026 while their earnings have been going in the opposite direction?
It's fascinating to watch, Penny, and a bit unnerving if you're a shareholder. Here are some examples from the first half of this year. Booking grew revenues by about 15%, while its shares fell 25%. Expedia grew revenues by 15%, and B2B revenues by 25%, but its shares still tanked. Webbeds grew revenues by 20%, and EBITDA by 24%, with shares down more than 40%. Serco grew total income by 34%, as its shares dropped by 50%. And, just as it broke into profit, SiteMinder's shares are down 45% this year. So to me, it seems like the profit and loss and the share price have simply stopped speaking. Rarely has doing everything so right been so poorly rewarded. So Jimmy, is the market wrong or is it just early? And have travel tech shares been hammered this hard because of the Gulf War or is it because of AI? And what comes next? How long will the recovery take?
Honestly, Margot, so much is happening that my crystal ball has clouded over. These days, it's more of a snow globe. Pretty to look at, useless for forecasting, and frankly better employed as a paperweight. But here goes. I think the market is overreacting to a near-term earnings surprise, while correctly spotting a long-term threat, AI's control of intent. So how long does the sector take to recover? Our base case is 9 to 18 months for scaled, profitable platforms to recover, and 18 to 36 months for their smaller peers. All of that is, of course, subject to two great variables, AI and Hormuz. I'm starting to think that AI is vastly more predictable than the Middle East. Let that soak in for a second. Some companies are going to come out of this wave of AI much stronger, and in parallel, there will be some new champions created. The weak will get weaker. You just have to study hard to work out who the weak ones actually are. Margot, we've talked quite a bit about downturns, but what about the spectacular recoveries that travel, and especially travel tech, tend to make?
That's right, Jimmy. Of the 18 shocks we studied across the travel sector over 76 years, one lesson truly stands out. The sector typically recovers very quickly, almost always within a year. The maths reveals the opportunity. A 45% fall, the 2026 median, needs an 82% recovery just to reclaim its high. About 60% fall needs over 150%. History says quality gets there fast. GFC survivors recovered most of a 57% drop within a year. For example, Priceline tripled off the bottom, and COVID's strongest names regained their highs in about 12 months. The base case is 9 to 18 months for scaled profitable platforms. The weak never return, so the alpha is in buying quality, not the index. The 2026 setup is textbook. I think investing at these levels, if you can navigate the AI and Hormuz risk, you're being paid to buy growth at a discount. If we're near the trough, history would point to roughly a double back to prior highs quite quickly. But with Hormuz and AI unresolved, this is the first cycle where defensibility, not just cheapness, decides what's worth buying. By the way, Jimmy, before you wrap up, this isn't investment advice.
Fair enough, Margot. But the lessons of history are helpful, aren't they? History may not repeat exactly, but as they say, it certainly rhymes. So, let's wrap up. Here are the 5 key points we'd like you to take away. 1. Travel is a cockroach. Demand went from 25 million travellers in 1950 to 1.5 billion today, and has never once failed to grow in any decade, no matter what war, plague, or recession threw at it. 2. The industry surviving and your company surviving are two different things. The register of names turns over almost completely each cycle, as value migrates from ships to planes to brands to screens, and now from screens to AI. 3. Fuel kills. But fear only bruises. 14 of our 18 shocks healed inside a year. So watch your leverage, your liquidity, and your cash, not the news ticker. 4. zero interest rates aren't coming back anytime soon. So if you're venture funded, stop mourning your 2021 valuation and confront the funding gap before the runway does it for you. And lastly, decide honestly which problem you've got. A low multiple on a growing business is survivable, but a vanished role in the booking chain is not. Event shocks are survived by design, whereas technology shocks are survived by choice. Thanks for listening. That's the Four Horsemen of the Travel Apocalypse, Penny Pandemic, Harry Hormuz, Margot Meltdown, and me, Jimmy Gemini, signing off. Subscribe to Tech Roundup for the full study and analysis. And thanks for listening. And remember, we fake humans rock!